When this famous bell rings each morning and afternoon at the New York Stock Exchange, more and more Chinese companies are on the minds of traders as they tally their books. Over 150 Chinese firms are listed in the US, a third are internet and technology based, but let's focus on just 5. Alibaba, JD.com, Baidu, Best Inc. and Sogu, with a special mention at the end for Tencent, which actually trades in Hong Kong. The biggest, of course, is Alibaba, the online trading platform that many compare to Amazon.com. Alibaba, led by CEO Jack Ma, one of China's most prominent entrepreneurs, is on a roll. Alibaba's Singles' Day sales each November dwarf anything comparable in the West. In late November this year, Alibaba's stock was up over 100%. It more than doubled before easing back this month. JD.com is nipping at Alibaba's heels. It's China's second biggest e-commerce company. Like Alibaba, it trades up the road in Times Square at the NASDAQ market site, which mostly deals with technology stocks. JD.com stock is up just under 50% for the year, trading in mid-December around $40 per share. Also traded at the NASDAQ is Baidu, affectionately known as the Google of China. Baidu is in fact one of the world's largest internet and artificial intelligence companies, and although in recent weeks it stumbled a little, in 2017 the stock has gained more than 30%, trading at more than $230 a share in recent weeks. It's always exciting when a Chinese company comes to market with an initial public offering. In September, it was the turn of Best Inc. Johnny Cho used to help run Google China, but gave it up to run his own logistics company with ties to Alibaba.
We met a lot of advisors and bankers, and people feel pretty good about what we're doing. People believing what we're doing, their career values for consumers and career value for shareholders. So we feel pretty good about it.
Since coming to market, Best Inc. stock has struggled to maintain its $10 per share IPO price. Logistics is a crowded marketplace. Another Chinese initial public offering just a few weeks ago here at the New York Stock Exchange was Sogu, China's #3 browser. It's the only one allowed to incorporate WeChat comments in its search results. WeChat is a very important form of communication among millions of Chinese people right now. Since coming to market, Sogu's stock has fallen from around $14 to about $11.15 per share in mid-December. Sogu is backed by Tencent, the Chinese conglomerate that owns WeChat. Tencent has tentacles in online payment systems, the iCloud, and it even has its own version of Netflix, the US streaming TV and movie company. Earlier this year, Tencent, which trades in Hong Kong, stepped in to help a company that was falling short here, Snap Inc. In March, Snap Inc. came to market in an IPO that proved disappointing. Snap Inc. shares rose at first, but then fell sharply. Just as things looked desperate for Snap Inc., Tencent stepped up to the plate and bought another 12% stake in the company, which is famous for making us all laugh with those crazy filters. Tencent first invested in Snap back in 2013 before it went public because of its potential in mobile payments and streaming to millions of young people. Since Tencent's latest investment, Snap Inc. shares recovered in mid-December, stabilizing at around $16, up from a low of around $12 in August, but still far below Snap Inc.'s March IPO price of $24. But if Snap Inc. pulls through, then shrewd Chinese investment will be seen as playing a part in its revival. John Terrett, CGTN, New York.